In this video, I want to talk about some of the differences, or maybe sometimes I refer to them as curveballs, right? Some of the circumstances um, and special situations and problems that time value of money questions can answer. So, first, let's start talking about some mixed cash flow streams. Essentially, this is really a more realistic kind of a corporate finance problem. If you think about a company and their income statements, right? No one year in the future is going to have an equal cash flow stream 2 years in a row. Right? Revenues are different, expenses are different. Things like depreciation changes over time. So we're basically have situations where if you're thinking about decision making about future in a business, we need to understand something about predicting those cash flows and then how to understand the values of those cash flows and the investment opportunities with those cash flows. So we have a spreadsheet that represents again here a series of cash flows. Notice the time zero, right? That's today. That's always going to be a negative number. We have to input the discount rate and you have to put the number of periods. So if you have 5 years of cash flows, 1 through 5, that obviously is a 5. We then have the solutions to talk about. We can calculate the present value of the cash flows, take all of those cash flows, bring them back to time zero. Now, if you look at this formula, the formula in Excel is NPV. You just put the discount rate, that cell, and then you have this series of cash flows. But the cash flows start at time 1, because if you remember, they're at the end of the first year. So 1 through 5, those would be the things that are highlighted, if you will. The future value of the cash flows, again, you're going to have the discount rate, obviously, that's in there. You need to know the number of periods, that would be obviously this cell. And then you would put the future cash flows, highlight those cash flows. Again, don't include the cash flow at time zero, right? That cash flow is only there to help us with the capital budgeting questions. Now, this is where it's a little confusing. Net present value is a capital budgeting technique, not the same technique as this. So to find the net present value, you take the present value of the cash flows and you add to it the investment, which remember is always a negative number. For the internal rate of return, you highlight all of the cells that you have, cash flows, including time zero, which is negative, and a guess. So here we have an example of a cash flow stream. We're a new product line. We expect to get a 13% rate of return on this investment. So what's the present value of these cash flows? Again, if you highlight these, that's the cash flow stream. Here's the discount rate, that 13%. It's $292,000 is the present value of the cash flows. Now, what's the future value of those cash flows? Well, this assumption says, look, at the end of the first year, you get $80,000, and that money is going to be reinvested at 13% for every year up through the end of the 7th year. So that future value cash flows, what is it if they're all reinvested? You would have $688,000 odd at the end of the 7th year. A question is, if this new line cost $250,000, what return would you receive on your investment, and also what is its capital budgeting net present value? And again, this is obviously all solved with those buttons once you input the data. So we end up here with that you'd actually earn 18%. So if you could earn 18% and it was going to, and you only wanted 13%, I think it shows you that you would want to invest in this. And indeed, if you were going to receive 292,000 in value, and it only cost you 250,000 to buy it, what would you get? The difference is what we refer to as net present value. If you want to think about compounding, we've talked about this several times. We need to understand how this process works. And in the formulas, it works because we identify the number of periods, and the interest rate per period is the rate that you use in our mathematical calculations. But the nominal stated annual rate, that's the contractual rate. That's the thing that you're told, right? If you go to the bank, they tell you you're going to pay a 6% interest on this loan. However, the effective or the true rate is the annualized rate, right? We need to adjust it for the annual or the compounding based on the number of payments. So if you make 12 payments per year, monthly, of course, we do that, then the effective annual return is calculated. It's 1 plus, again, the annual return divided by 12, in this case, to the 12th power. Then you subtract 1, gives you the percentages. So what does this do for us, if you will? So the effective annual interest rate is the number we want to talk about. So if you have 12% rate of return and it's annually compounded, when you plug that data in here, the 12% for interest and the compounding period, one of the things that calculates for us is the effective interest rate. So annually compounded, the annual rate and the effective rate will be equal. But if we compound it monthly, when you plug in the 12 for the compounding frequency, you're going to find out that the effective interest rate is greater. Why is that? It's because every month you earn 1% on the principal, but you also earn 1% on all of the interest that has been earned before that, right? Interest is earning interest. So you actually earn a higher rate of return. The effective interest rate is higher, 12.683%. So again, we have these numbers, this differences. The annual percentage rate, that's the nominal rate. Sometimes they refer to the effective annual rate as the annual percentage yield. Right? So there are some differences in terminology depending on your textbook, depending on the circumstance in the financial environment. So let's look at some other typical problems we can solve for. We can solve for rate of return, or you could talk about the growth rate, right? So we purchased an investment 4 years ago for $1,250. It's now worth $3,000. What's the compound annual rate of return that they earned on this investment? So we need to input the data. Now what you'll recognize is what? Present value has to be negative, negative $1,250. Future value is $3,000. The time in years is 4. We're solving for interest rate, so that's blank. Compounding frequency is 1. So this interest rate, we're going to earn 24.47% is what we have earned on this investment rate. Can we solve for time? Right? So you're going to invest $1,000 at 8%. How long does it take for that to grow to $2,500? Negative 1,000, present value, 2,500 is the future value. This time we're solving for time, so that's blank. 8% is the interest. So the actual solving for the time here, it's going to take roughly 11.9 years for this to double, or excuse me, for this to go from 1,000 to $2,500. $100. There is a special approximation that we can use that talks about how long it takes for money to double. Here you take n, the number of years, approximately, it's 72 divided by the interest rate. So if you invest 8%, how long does it take to double? Well, 8 into 72, it takes roughly 9 years, approximately. If you put it in the time value calculation, you find out that it actually is 9.01 years. So it's a very close approximation to exactly how long it takes money to double. Another application that we can talk about is loans, right? So loans are what we refer to sometimes as being amortized. When you borrow money to buy a car, you make equal payments every month for the life of the loan, and each of those payments is equal, but their composition is different. Interest is only based on how much you owe. So as you pay off the loan, the interest that you owe each month is less, but the payment is the same. So what is happening is more money goes to the principal over time, less money goes to interest over time. And we can create what's referred to as a loan amortization schedule. And this is going to show us how each payment is broken down into its interest and principal components. The reason this is important for a business is that interest is tax deductible. Now, the principal of the loan is not written off. How the asset is written off is through depreciation that we've talked about in some other videos. So you can't write it off twice. So again, this amortization schedule is going to help us understand what the interest expense is. So let's look at an example. You're going to borrow $6,000 at 10%. In this case, we're going to make one payment a year over 4 years. So what's the payment if the interest rate is 10%? So there is a special worksheet, a loan amortization worksheet, where you put in the loan, how many years of the payments, or how many years the loan is, and then how many payments per year is. This is M. In this case, we're saying it's 1 with 10% interest. So the payment per period, $1,892. So the total you're going to pay, 4 times $1,892, you're going to pay $7,571. So the total financing cost is $1,571. 7,571 minus 6,000, that gives you the total financing costs. The amortization schedule on this worksheet, if you scroll to the right on the worksheet, you'll see how it breaks down. The first payment you make, $1,892, $600 of that is interest, $1,292 is principal, which means now you only owe $4,700. 10% of $4,700 is roughly $470. Subtract that from $1,892 means the principal repayment, the second period, is more, $1,422, etc. And you see at the end of 4 years, this loan is completely paid off. One other example that I think is particularly useful is to understand a little bit about retirement, right? Now, I've done this a couple of ways, and we're going to follow these numbers here for the example, but I've provided a space here where you could put your own data and calculate this for yourself just to see how you're faring as far as your current retirement plans. So let's look at how do you calculate your retirement income. We need to know how much money you're going to need to receive during your retirement years. So let's assume you currently make $60,000 a year. Inflation is currently 3%, and you plan to retire in 40 years. So what will your income be in 40 years if it grows by inflation? Well, when you calculate that, again, if the present value goes in as negative, this says when you retire the very first year, you're going to need $195,000 a year in retirement to live the same way you are right now on $60,000. Of course, taxes would be taken from that, just like they are taken from now. Your tax situation may change. It may not, right? But we need to understand we're just predicting before taxes what you're going to need based on today's situation. So if you need $195,000 a year, how do we figure that as the investment that you need, right? How much money do you need to save between today and the future in order to get that money for the rest of your life? So what we're going to assume is during retirement, you can get 8% on your money, a little bit less than before retirement. Let's assume that you predict you're going to retire at 65 and you need money till you turn 90 for 25 years. Compounding frequency is 1. The payment, you're going to receive $195,000 a year. And let's also take a look and see what will happen with inflation. When you plug those numbers in, the answers are down here. Between now and you retire, the present value of an ordinary annuity, you need to save roughly $2 million. $2,089,000 odd dollars is what you need to have in your retirement account if you don't care about inflation during retirement. If you want to cover predicted inflation of 3%, you actually need to save $2.7 million. So let's go with the bigger number, right? If you overestimate how much you need to save, that's better than underestimating, I think. So you need to save between today and your 65, you need to save $2.7 million. How can we do that? Well, in our example, we said you need $2.7 million in the future. We assume that you already have $5,000 in your investments. 11% is your annual interest rate. You think you can earn that on average over the next 40 years. And in this case, we're actually looking for payments. What does your monthly payment need to be in order to gather or to get this amount of money? If you look to the lower right here, we can see you need to put away roughly $269 a month. Now, if you have an employer who will match your investment dollars, you really only have to put away, I think that's roughly $135 a month. Or if you could put away $269 and your employer would put away $269, you would be able to double this amount of money. So you'd end up with $5.4 million instead of $2.7 million. One of the things we said is, like, if you're currently investing like 5% of your money, how much do you have to pay, or excuse me, what rate of return do you need to get on your current plan in order to get to retirement the way you want to? So in this case, we said your payments, you're going to invest $250 a month. That's 5% of the income that we stated earlier in the example, right? Or in the numbers we talked about earlier. So what that means is the interest, you would have to earn 11.2%. So if you could earn 11.2 and you're already investing $250, you'd be able to retire with that 2.7 million. What would you think would happen if this number came out and said you needed to earn 17%? Well, 17% is an impossible average rate of return over 40 years. So what that would tell you is you need to figure out a way to invest more, right? You need to increase the payments so you can get where you want to go. Or you have to change the amount of money you want to have during retirement. So again, these are some very special kinds of applications. I look forward to talking to you the next time.